Hi, I'm Dr. Melva, your board-certified radiation oncologist and serial entrepreneur and investor. Welcome to the 1% Code podcast. I help top income earners create multiple streams of income to support the career they love or the one they want to love again. Learn more on the 1% Code podcast. Hello, and welcome to another episode of the 1% Code podcast. I'm your host, Dr. Melva, board-certified radiation oncologist, serial entrepreneur, multi-franchise owner, and investor. And I'm so happy that you're joining me here today as I help to educate you on creating a lucrative passive income stream while still working your 9 to 5. In today's episode, I'm so excited that we are hosting Denis Shapiro. Welcome to the show, Denis.
Thank you, Melva, for having me on. It's a pleasure to be here.
Welcome. So let me introduce you to our audience, all right? So Denis began investing in real estate in 2012 when the market was just beginning to recover from the GFC, global financial crisis, for those of you not familiar. He built a cash-flowing portfolio, including many alternative assets, such as Note and ATM funds, mobile home parks, life insurance policies, tech startups, industrial property, short-term rentals, and more. Wow. He co-founded an investment club for accredited investors in 2018. Following the success of his investor club, he launched SIH Capital Group. SIH Capital Group provides accredited investors with a simplified strategy to invest for passive income. All right, Denis. So tell me more about this and introduce yourself to my audience, and let's get started. I'm happy to have you here.
Yeah, awesome being here, and I know that was a handful. So thank you for saying that. So I started investing in when I was only 14 years old. My oldest brother gave me a copy of Rich Dad Poor Dad. Mm-hmm. We come from a family where if you find something good, it's like your job to brainwash the rest of the family members into liking the same things that you do. So he read Rich Dad Poor Dad. He absolutely loved the book. He's like, Denis, you got to read it. I read it and I was very cynical. I was like, oh, this guy's probably making more money on his talks and his speaking engagements and on the book than the stuff he's actually writing. But I did read the book and I was like, you know what, I should buy my first asset. So I bought my first mutual fund. It was like a part-time job I was working like a pizzeria and an ice cream shop. Mm-hmm. I saved up like my first $1,000 and I opened up a brokerage account. I remember it was Scotch Trade at the time. Mm-hmm. And the trade cost me $7 to make. And I'm old enough to actually say I had to pay for a trade. And I remember following that mutual fund for the whole year. And I was like, oh, I'm just waiting to be rich. And it kind of never happened. So then I started getting into more of the traditional side of things. And I was like, well, if mutual funds isn't the answer, well, maybe I have to learn how to individually pick stocks. So then I started following along Warren Buffett's and Peter Lynch's. And I really went down that rabbit hole with the intentions of making a career out of stock picking. I really want to be like the next Warren Buffett. Like, who doesn't want to be the next Warren Buffett?
And this was at age 14?
14 through high school, going into college.
Okay.
So I had the fortunate and unfortunate timing where I went to a business school right in the smack of the global financial crisis. Mm-hmm. So I was literally going for job interviews and getting to the second or third round and then get like an email that the company is no longer in business. So It was definitely an interesting time period. So I wanted my whole career to be in the equities place, went into the global financial crisis and said, okay, I got to pivot. So I went straight for my MBA. And while I was in my MBA, I got recruited by the government. I was like, wow, it's really nice being recruited. You know, you're in a financial crisis. So I was like, I guess I'll go work for the government. And then I got my first paycheck. And I was like, wow, not only is the government my employer, they're also my business partner because of the amount of taxes they're taking out.
Right.
So that's when I got into alternative investments. I think I Googled, I think I got home with the first paycheck. Mm-hmm. And I was like, how do I pay less taxes legally? I think that's what I searched for. And I kind of got into, buying real estate is the answer. So I got into real estate. I made every mistake known to man. That was about 10 years ago. And in 10 years, I've been slowly kind of transitioning from single family rental to more of the passive side, more of the note funds and ATM funds and life insurance policies. And I kind of got deeper into the rabbit hole in these last 10 years.
Okay. Let me kind of stop you there and ask a little bit. So a lot of my audience are high income earning professionals, doctors, lawyers, dentists, and the question or the thought you had that kind of propelled you into real estate is how do I legally pay less taxes? So I think that's a question that a lot of my listeners can relate to. So let me ask you, did you see the benefit of doing that where you started initially, or how have you made that transition from what you listed that you started in the beginning to what you're doing now? Was that a difference in the less taxes, or is that more of a preference, return on investment? How did you make that transition?
So the first an alternative investment was single family rental. I actually bought it from my oldest brother, which was a big mistake. Had to highly recommend to your to your community not to buy from family your first property. I did no market research, did nothing, but I did do enough analysis where I was like, if I just hold on to this thing, I could even break even and lose money on this, but I'll save money on taxes with the depreciation. And I would be actively managing it, which helps with taxes. So I did that calculation. I did know a little bit at that time, but as I progressed in my alternative investment career, let's say, I realized how tax friendly it can be. I hate the term, like if you're in the syndication world and you're looking at these private placements, the term like tax friendly is thrown out there as like a marketing gimmick. And a part of what you realize is that it's not really tax friendly. A lot of these alternative investments allow you to do the pass through depreciation. And what it allows it to do is tax defer a lot of your gains. And tax deferring still requires a lot of planning, a great CPA, and everything like that. So I don't want to go and say like, hey, I discovered, real estate and I never paid taxes again.
Right.
I made very calculated decisions initially where I knew I would at least break even. It was a terrible investment, but it did fulfill the goal I wanted to. And as I got more knowledgeable in alternative investments, that's when I realized that with the right planning, it can be very tax friendly and deferred.
Okay. So I'm not as familiar with a lot of and maybe this will help my audience too. I know we know a lot about real estate syndications when you look at passive investing. Like, for example, there are a lot of physicians in my audience or listening area who really don't want to be active investors and they're looking for passive income opportunities. But I'm just curious as far as the ATM notes, mobile home parks, life insurance policy, tech startups. How are you doing that? And are you still doing that? Or is it only real estate syndications that's your focus now?
Okay, so that's a great point. You don't want to be like a jack of all trades. You want to have knowledge in certain areas. So I'll start off with the fact that apartment buildings is core to what I do. That is my bread and butter. And what ended up happening is while I was networking with other apartment building investors, because at that time I wasn't an operator, what I ended up having with these conversations where I would have a 30-minute call with someone to discuss maybe a different limited partnership opportunity, which is 100% passive with another investor. And the conversation will start off about what did he think about that operator? And then by the end of the conversation, he would say like, you know what, I had a really good opportunity in self-storage and mobile home parks. And these were asset classes that I didn't really know at the time. But what I realized is that apartment buildings were like a gateway kind of drug in that sense, where a lot of the terms being used in apartment buildings are directly relatable to the other alternative derivatives, I call it, which is I would put apartment buildings, self-storage, mobile home parks, all of those. Once you kind of see a private placement memorandum in one and see a business plan in one, they're very transferable. So it's not that if you're an apartment building investor, you should go out and buy your own self-storage facility. But if you're an apartment building investor, you'll be surprised of your ability to look at a self-storage deal and being able to analyze it without ever seeing another self-storage deal before.
Okay. And just with that said, is that something that comes across often for you where you're having the opportunity to look at apartments and self-storage and the other ones in the asset classes you mentioned?
Yeah, so I've had opportunities where I've had opportunities to joint venture on a mobile home park. I've had the opportunities. My main operational opportunities always came from the apartment building side, but in terms of investment, the investment opportunities as a LP, once you kind of go deep into the limited partnership side and you have maybe 5 to 10 operators and maybe a list of 10 fellow limited partners, you'll get presented with those opportunities all the time. That's why a lot of that is why I wanted to write my book, was to actually explain how relatable a lot of these alternative investments are, where if you put in the time to learn about apartment buildings, you actually have other opportunities as well.
Okay. Okay. So for my listener out there who has been career focused, like for me, for example, as a board certified radiation oncologist, 14 years in, student loan debt, and it was this transition to the freedom world, the entrepreneurial world, tax depreciation, real estate investor status, all of these, terms, like you said, that reduce the legal tax load. Where does someone start? Okay, so say someone has some money and they want to grow their money. Can you tell us more about, I know you talk about some of the platforms like LinkedIn. What is the language to learn about real estate on LinkedIn? How can you find these partners, learn about it? Where would you have them start?
Sure, that's a great question. So I would like to start off with, if you there's a common misconception out there of being 100% passive, right? You hear the term over and over again. The problem is, if you're 100% passive without any education and knowledge, what you really are is 100% gambling, right? At that point. So I believe the first step for most people who will look into private placement, private security deals, is to realize that these things are expensive. Just because you make a great salary and just because you have a high net worth doesn't mean you should throw away what, in most cases, a minimum investment is of 50,000 or more. So that's the first thing to realize, is that you should gain the knowledge so you could protect those investments, because they are great investments once you build up that knowledge. So how I recommend, and this is kind of how I did it. So what I did with LinkedIn is you just literally go into your profile and just put real estate investor. So you could still have your main, oncologist and everything like that, but also put in a section that says, a real estate investor. Or if you're looking for not real estate, business investor, or whatever the thing is, just put in the words investor. Because what happens is there are a whole slew of people out there in LinkedIn that kind of scour that type of verbiage in your profile, and they'll reach out to you. Now, this does not mean you should be investing with those people. I just want to make that very, very clear. Is that they'll reach out to you and they'll try to take 15 minutes of your time, 30 minutes of your time. And honestly, most of that is spam. And most of that, you have to realize that. But what it will help you do is it will present you with the verbiage that you do need to learn, the basics. So let's say you get a new real estate operator and they're so excited. They see the fact that you put a real estate investor. They see the fact that you're a doctor. They feel like, oh, that's, prime target for them. And they may have never done a deal in their life. They just did a coaching class for 2 weeks, and now they're taking down this $8 million deal, and they're reaching out to you, and they're going to be super excited for that deal. What you need to do is objectively listen to them and listen to the terms being used, because there's not a lot of them, but it's its own language. It's like when two medical professionals are talking, they talk their own language. It's English, but good luck as a third party bystander, listening to that and trying to figure it out, right? We can't even read the scripts. There's a reason for that. So once you hear the language, write down what terms you didn't understand. After the call, thank them for their time, whatever you feel is appropriate, but then go look up those terms. Once you realize that you have a good grasp of those terms, then you could go to step 2. Step 2 is to start going out and networking with people. And usually that's as simple as going to a conference or a meetup. And I know this sounds really time consuming, but if you go to one good conference and you network with 5 or 6 good investors, that's all the conferences you'll ever need to go if you truly want to stay passive. Because now you have 5 people to call on a quarterly basis and see, hey, I'm thinking of putting money in this deal. Have you ever heard of this operator? It takes time to build up that relationship, because that's not the first phone call, right? You're not going to go and start disclosing, hey, this operator is terrible, because you don't know who that person is. But if you go to a conference, and the way that I tell people to understand which conference to go to is look who the speaker is. Right? If you want to be 100% passive, you shouldn't be looking to build up a single family rental portfolio. What you should be doing is looking where other operators of larger buildings are speaking at.
Right. I'm going to pause you right there, just for anyone who's new and doesn't know the real estate syndication. If you could just quickly, in like a 30-second, define operator, LP, GP, limited part. If you could kind of go through that for us really briefly.
Yeah, absolutely. So I'll start off with the term that's used most as syndication. Syndication is just the pooling together of money. That's all it is. Now, in a syndication, there's usually a general partner and a limited partner. So a general partner, this is their career. they go out, they find the building, and they put the business plan together to maximize the value of that building.
Okay.
The limited partners are usually the ones that are actually putting up the money.
Okay.
And they are very passive. The words limited actually means that they have limited liability, and they have limited, so it's limited liability, and what's the other limited?
Do they have limited input also? Like they're money investors, but they can't say, no, we want these type of windows in the apartments, right?
Exactly. So they have a very limited say. So, they're not going to get sued for that building, but at the same time, it's not their business plan. They need to be investing in the business plan. So what I like to say is the moment that the limited partner wires the money to the general partner, it is 100% passive after that point. Okay. But the point to get to the point where you find the operator, where you do your due diligence of the operator, that's the active role. Okay. And that is the role that almost every, even if you're a high net worth individual, they should either be the ones doing that homework beforehand or really trust someone who's doing that work for them.
Okay. And the definition of the operator, you said, is the one who is facilitating the deal?
Yes, they are the ones actually putting together the deal. So they'll find the property, they'll go check out the property, they'll get the property under contract, they'll make a nice presentation, they'll go through the securities attorney to actually put together the securities document. There's a lot of work that goes in hand. And then usually the profit is split. So the profit is the most usual format is like a 70-30 split. That means the limited partners would receive 70% of the deal and the general partner would receive 30% of the deal.
Okay. And general partner and operator are interchangeable, or those are two separate words?
Interchangeable. I'm sorry, I didn't specify that.
Okay. Okay. So that's the same. So those are the three main terms we would need to know in a syndication to be intelligent?
No? Intelligent, but to start the conversation, because the reason why it's important to know the lingo is because if you go to a conference and you know nothing, what ends up happening is you're going to come off in a position of need, and that's going to come off as that you're looking for like a coach and a mentor versus going to a conference and saying, hey, I am looking to place my money in fellow investors. And if you could talk at least some of the lingo, people will more readily gravitate to that and be like, yeah, I'll exchange contact information with you. I'll get on a call with you, once every 3 months. You're not trying to make best friends. What you're trying to do is create like a small network. It's not huge. It's a small network of people that you can trust their unbiased opinion. Because in this world, if you're an limited partner investor, when you get pitch these deals, it is literally them pitching you, and it's their job to sell you on this deal. So you're going to get a very unbiased view of that deal. So your job is to be able to network with people that can shed some of that biasness away from the deal. Right.
So you're going to get a very biased view is what you meant to say there, right?
You're going to get a very biased view from the operator, but you'll get a very unbiased view from fellow investors.
Your network. Right. Yeah. And I think that's kind of just, so my husband and I, we've been investing in real estate for almost 10 years now. And I would say that's definitely solid advice, because when you don't come to the table prepared, you get other people, like you said, selling you things or just saying whatever. Like, for example, I was talking to a lender a couple of weeks ago, and he kind of threw out like 80% LTV on multifamilies. And I'm like, really? Like, that's where it is? And then I asked him like subsequent follow-up questions, just like bam, bam, bam. And he was like, okay, well, I was just throwing out 80% LTV arbitrary, but because you asked that, he gave me like a real answer. It was kind of like, okay, like, let's not waste our time here. I'm actually seasoned. And I don't know what it was I said after hello that made him think I wasn't, but I definitely understand that. It's kind of like some people are in these sales positions where it's like they don't really care unless you come to the table prepared. So I think that's really good advice. All right, so let's talk a little bit, and you talked about this a little bit, but someone who's looking to start their network from like zero. Okay, you talked about that on LinkedIn a little bit. Is there anything else you'd add to that as far as starting your network if you haven't got into real estate investing or thinking about syndications?
Yeah, so the LinkedIn part is literally just to learn the lingo. Okay. And you could learn the lingo, you could bypass LinkedIn and honestly just pick up a couple of books on investing in commercial real estate, and you'll pick up the same lingo. It's kind of better to have that practice of talking to someone about it versus just reading it. It's like a very different level of kind of like understanding it and how is it used and everything like that. You're not going to get that from the book.
Right.
So the lingo builds up the your confidence into being able to actually establish the network. And then once you actually have 5 or 6 people, what I recommend is quarterly calls, because obviously your time is precious, your investor, your community's time is precious, and the people you're trying to network, like if you try to say, hey, how about we get on a weekly call, like unless they have completely no regard towards their time, they're going to say no. So you want to make a request that's reasonable. So I find that quarterly is very, very reasonable. And then usually you'll know between the first real half-hour phone call if this person's a good fit for your network. You want to be honest. You don't want to waste your time. Like if someone only is interested in investing in franchises, and you're only interested in investing in apartment buildings, that's probably not a very good fit unless you one day want to invest in a franchise and then connect with them, and vice versa. But the chances are, if you're going to an apartment building conference, you're going to network with other apartment building investors.
Right. Okay. So let's kind of flip it a little bit. So you've started your own syndication company, is that correct?
Yeah.
How much startup capital did you need for that? Or did you start out as an operator and you had limited partners? How did you start?
So it was a very, very long journey. So after my single family home, I started investing in more passive stuff like the ATM funds and the notes, and everything was done from a limited partnership perspective. I wasn't an operator in any of those deals.
Okay.
So it's also important to see how transferable the knowledge is. So for example, I invested in a note fund, and a note fund is basically a company that buys mortgages either in first or second position and then pays you a certain dividend. So let's say I would invest in a note fund. I would see a securities document. I would get practice at looking at it, and I would go through the subscription documents. Now, when I go and invest in an ATM fund, even though it's a very different industry, it's the same type of securities document. It's the same type of verbiage, like what's a preferred return and what's not. All of that is kind of very, very similar. So for 10 years, I was building up this portfolio of different note funds and ATM funds. And what I realized was I kind of had a knack for it. And at first it was like, okay, I wanted to diversify from my traditional portfolio. I didn't go out and say, I'm going to sell all my stocks and I'm going to go and invest it all into single family rentals. What I did was I kept struggling to find income from my traditional portfolio. Where if I tried a strategy where I'm going to go buy some utilities and mix it in with my low cost index funds, the utilities would always underperform. And then whenever there was a market correction, the utilities are supposed to be protected and they went down just as much as the regular market because of the way the algorithms are in play. So I've tried the utilities, I've tried REITs and MLPs and all these different strategies, and they always failed. What I realized is the alternative side was much more consistent because these were private securities. They weren't traded on the market. Because what I realized is that the market has unlimited liquidity, which leads to unlimited volatility. And volatility destroys yield.
So just explain those two things from our audience if they're completely new to this, volatility and liquidity.
So the first term is liquidity. Liquidity is always cited as a positive for the stock market. But to me, it's 100% liquidity is a negative. What that means is that basically you could almost trade at any time. So if you start seeing red and you turn on CNBC and all these experts, are telling you how the market's going to go down, 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 you might have no intention when you woke up to sell, but your emotional biasness will take you to the point where you're like, hey, maybe I do need to sell to protect myself from the downside. So that's liquidity. Liquidity means that you could basically trade at almost any time and get your money out of it. So because you have unlimited liquidity, mostly unlimited liquidity, there's parts of the night, half-hour trading and stuff. But because you have unlimited liquidity, that leads to unlimited volatility. That means a stock could basically go as high or low as it wants, as the market demands. There are stoppage places in place. I think it's a 10% limit where the market stops trading, but more or less that's the case. So because you could trade at any time, that leads to really big moves. That's the volatility. And because of those big moves, it destroys the yield of those plays. Like for example, if you invest in a bunch of REITs and you're getting 8% yield, right? And let's say you have 2 years where the REIT didn't really move, but you've collected your 8%, you're really happy. However, in year 3 and month 1, COVID happens and you're down 34%. All your yield, because you got very little appreciation in the stock price during that time, all your yield is gone in a matter of a day or two.
Right.
So that's where I realized that was like poison for income. I realized that traditional is great for appreciation. If I never look at the news and buy a low cost index fund, I could never, do that. But the alternative side, the private security side, that's where you can really get higher yield. So as I started, coming up with, what portfolio makes sense for me, I started building up more and more of these different alternative investments. And as I started networking with, I networked with two people that kind of changed my life, where we realized hey, instead of me doing one of these syndications, why don't we pool together and do a couple of these syndications? So what we did is we kind of by de facto started an investment club. And that's when my kind of career took over, because instead of one or two deals, we did like 12 deals in like a year or two. And that allowed us to really test out certain theories and strategies and everything like that. And once we saw that there was success there, that's when I actually launched the SIH Capital Group, which is basically a REIT that's not traded on the stock market, because that's what I was.
So REIT, the REIT comes up a lot for my audience, but some people may not be familiar. Can you just define that a little bit? Because also the question that comes up a lot that I get asked is the difference between a REIT versus a real estate syndication. So I'd like you to kind of just define that for us.
So a REIT is a real estate investment trust, and basically what it's supposed to do is it's supposed to give the person exposure to the real estate world with the ability to just trade it on the stock market.
Okay.
So they are private REITs as well, which is kind of similar to something I created, but not exactly. That is different than a syndication, because a syndication is you're buying into usually one LLC that controls either one apartment building or a collection if you're doing like a syndication fund.
Okay.
So it is different because REITs are subject to certain laws, like they have to pay out a certain percentage of their profits. A syndication is not. So it's very, very different. Also, syndications allow for pass-through depreciation and REITs do not. So it's also a tax. It's a certain, because you are literally, as a REIT, you're a shareholder in the company. As a syndication investor, you are a partner in the company.
Right. So you have that asset backing up your investment. Correct. Where you get the depreciation.
Yes. And you get a Schedule K in the syndication side. You don't get a Schedule K on the REIT side.
Okay. And the returns are much different, correct?
They are, because the returns are going to be, so the REIT is going to be subject, a public REIT that's traded on the stock market is going to be subject to how the stock market perceives it. So for example, during COVID, right, the majority of REITs were down exactly what the S&P 500 was down. I think it was down to like 34% at one point. The reason is because algorithms are very, they don't discriminate. If everything is going red, it's going to go red. However, the private side, so what happens is, because a private security is based off, let's say, one apartment building, it's not easy to sell that apartment building. So the value of that apartment building is not going to change dramatically. So what ended up happening in the syndication world is when March happened, there was a huge pause on market transactions. No one was selling or buying, because what ended up happening is the buyers were looking, they were like, oh, this is blood on the street. We're going to come in and we're going to scoop up these apartment buildings for pennies on the dollar. The sellers are like, hey, let's wait and see what's going on. We're not willing to give that discount yet. So that disconnect actually caused basically no transactions to happen. So while the REIT side was down 34%, the private security world, the syndications actually did not trade hands at all. So you actually had that, that's where the advantage of not being liquid at that time, because you couldn't trade it. You can't just sell your private securities like that. But because of that, you weren't looking at a negative 34% collapse in your market value.
Right. Wow. Okay. This is all very good. I hope everyone is listening and taking notes and maybe listening to this again. So let me ask you one more question. Let's talk about the FIRE movement. I know you talk about what that misses out on. Tell me more about that movement and your thoughts around that.
So I had this epiphany. I was working, I think 70-hour work weeks. I was working for the government. There was a lot of overtime, and I was just like a sucker. I didn't have a family. I was like, I got to keep working overtime. And I was naturally a really good saver, a really good investor. And when I found out that, hey, if I save enough, so the FIRE movement stands for Financial Independence, Retire Early. Basically, the movement's been around for decades, but it's been popularized by a couple of big blogs in the last decade or so, where I think there was like more like the engineers, and they were like, well, hey, if we take a complicated topic like retirement and we boil it down to a simple formula, then we could go for just a specific number, and then everything else can kind of resolve itself. So what they realized is that because there was a famous study in the 1990s called the Trinity study, where as long as you don't spend more than on average 4% of your total portfolio, and you have a certain amount invested in the stock market, your savings should last you for your entire life. So this formula basically just comes down to, can you save 25 times your expenses, invest it, and then live off that amount and adjust it accordingly. Okay. So that's kind of the financial independence, retire early in like a very simplified version. So when I found out about this, I was like, wow, I thought my number was going to be, 3x, and it turned out to be only 1x. That made me feel really, really good. It also was like, wow, there's a lot of people out there that actually save and invest, because there weren't many in my network that were doing that. Right. So I kind of went in and I just dove in. I saved even more. Like I didn't go on a vacation for 5 years prior, and the thought of vacation didn't even like come into my mind afterwards. So I started really penny pitching. Like I went from like a 50% savings rate to like a 70, 80% savings rate. So I was doing everything by the book. My numbers were growing. And what I realized was that my tunnel vision was not focusing on A, the journey, but B, on the what after, what's next. Right. So it's like, okay, a lot of people in the FIRE movement, they'll be like, okay, if I hit X number, I could quit. And if I quit, what are you going to do? Right. So they always have this like set bucket list. So they say, well, I'm going to travel. That's number one. Right. Like if this was, what is that? Not Wheel of Fortune, that game where Price is Right. Like number one is always travel, always. Right. Number two is like catch up on your like Netflix queue or whatever it is. And then like number three, you'll be like, I'm going to homeschool and spend so much more time with my kids. Right. And then what ends up happening is people travel and they realize that, hey, it's great, but I'm getting homesick. I want to come home. And then they catch up on the queue, and the queue is gone. Right. And there's nothing to catch up on. And then number three, they get their kids home for like 2-3 days, and they're like, how do I re-enroll them to school? Right. Like, how do I do it? Like, this idea was great, but like having my kids, I'm not enjoying them because I have this pressure and everything like this. This is not what I wanted. And now you enroll your kids in school, and now it's like, then what? Now you haven't built your next chapter. Right. And that's where I'm really fortunate, because as my alternative investment portfolio started building and I started networking with all these amazing people, and was like, wow, you could do this. You could get a control of your time, but you could also invest in businesses and do all these things which allow you to be more charitable, and you could be a greater part in the community, and all of these little things that you don't need to just be like, hey, I'm just quitting. It's this the next stage where I think it always misses out on.
Right. I like that. I think it's definitely an evolution, and kind of like you said, I think that big, hairy, audacious goal kind of, concept, a lot of people, and especially as top income earners, we don't think of that, because for many of us to get in the career position where we are, that was it. And then once you got there, it was like, gosh, what's next? And that's when you start talking about like the philanthropy and what other things can you do, and how can you accumulate more wealth so that you can do more of what you really care about. So I think that's awesome. Well, it has been a pleasure chatting with you. I think everyone has learned a lot. I know I've learned a lot. If we want to find more of Denis, if anyone wants to work with you, where can we find you, and where can the audience reach out to you?
Hey, thanks for having me. The pleasure has been all mine. So my website is sihcapitalgroup.com. If you go on it, I have 2 abridged versions of my book. We didn't really talk about the book, but if you go on Amazon, it's the title is called the Alternative Investment Almanac: Expert Insights on Building Personal Wealth in Non-Traditional Ways. Go
ahead and tell me a little bit about what that book is about. Yeah, so we know, so they know if they're going to look at it. Yeah.
So just some of the stuff that we mentioned, like apartment buildings, self-storage, and mobile home parks, what I realized was there was large communities out there that had misconceptions of what those terms are. And they were like, oh, it's an ATM fund. That must be a Ponzi scheme, right? So what I realized is throughout my years of networking is there's a collection of these assets out there that have very similar qualities, where it allows you to transfer your knowledge over. And I just wanted to show investors out there that there was a way of having a traditional portfolio, but also building up an alternative portfolio and what are some of their options on the alternative side. So that's where each chapter is kind of unique, where one chapter will be on apartment buildings. So it'll be like 20, 30 pages on apartment buildings. And then you'll get into what's called Ask the Experts. And there'll be 2 Q&As of like two apartment building operators, just people in that space. I think my apartment building space, they had like 100,000 units between the 2 of them that participated. So you see how the experts answered the exact same questions. And this way, if you read the chapter on apartment buildings and you say, wow, I really want to I really want to learn more about it, I can now go and start listening to a podcast on apartment buildings, or I could read a book, because 2 of my guests, one of them already has a huge book on apartment buildings. So you could go in and actually just get their book and contact those operators. So that's how I wanted to structure the book. And at the same time, I also didn't want someone wasting their time. So if they didn't like the idea of apartment buildings, they don't have to read 300 pages to come to that conclusion. Okay. So they could kind of go on to the next asset class, like a life insurance policies, because each asset class kind of has its own unique risk and reward profile. So only the reader will know which asset class they'll be attracted to. So that's how I shaped out the book. And on my website, if you go in, and there's actually abridged versions to there's an abridged versions of the Q&As, and there's a abridged version of the actual content. So if you go on my website, sihcapitalgroup.com, and you sign up for my email list, you'll actually, get those abridged versions.
Okay. Awesome. Well, that definitely sounds like a great start, especially for someone looking to see if this is for them and what's for them. And you mentioned a lot of options. So that's awesome. Well, everybody go check out Denis Shapiro. And when are you starting your podcast? Are you working on that? Is that
I've been on
2022?
I've been on a lot of podcasts. I want to do some YouTube videos on some of the stuff, but I find it hard enough to coordinate with 3 kids to get on people's podcasts. I was like, I give you all the credit in the world for doing such a great job. I've listened to a few podcasts and I absolutely love them.
Thank you so much. How old are your kids?
5, 3, and 2.
Oh my goodness. Yeah, mine are 7, 10, and 13. So a little bit older. So yeah, we wish you luck, and we like good dads out there. Well, thank you so much for being on this podcast episode. I hope that everyone enjoys it. Please go check out his book on Amazon, and we will link that. The link to the book is on your website as well, correct?
Yep.
Okay, awesome. Well, thank you everyone so much for listening to another episode of the 1% Code Podcast. I hope you learned a lot today, and we'll see you on the next episode. Thanks for listening. If you enjoyed this episode and you'd like to help support the 1% Code Podcast, please share with others, post about it on social media, or leave a rating, and I would love your 5-star review. To catch all the latest from me, you can follow me on all social media channels at Dr. spelled out DoctorMelva at Dr. Melva. And I want to make sure that you and anyone else you know that would benefit from the 1% Code Podcast is a member of my private community on Facebook, the 1% Code Collective. I would love for you to join me there. Link in the bio. Thanks again, and I'll see you next time.